Hello, everybody, and welcome into Commodity Culture, where we break down commodities markets, sound money principles, and geopolitics, all with the goal of making you a better investor in the commodities sector. Today is December 1st, 2025, and I'm thrilled to welcome Clive Thompson to the program, a former director of wealth management with 47 years of experience in trusts, wealth management, and private banking. Silver continues to break out, now at around $57 an ounce, and Clive thinks that although we may see pullbacks along the way, we are still in the early stages of a generational bull market that could see prices soar into triple digits. Clive is also very bullish on silver miners, and he provides his top picks in the sector, along with diving deep into the gold market, the strategy for his winning beat the benchmark portfolio, and the sinister truth behind the coming rollout of the digital euro. All of this and so much more ahead, so strap yourselves in for my conversation with Clive Thompson. Clive Thompson, it is great to have you back on Commodity Culture. I want to kick the conversation off with silver today, as the metal recently broke out to new all-time highs, currently sitting at around $57 an ounce. What are your thoughts on the recent price action in silver? And do you think the metal still has a long ways to run from here, or should stackers and investors potentially consider taking profits at these levels?
Well, the size of the move that we've seen has been unprecedented. Having said that, unlike the bull market we saw when the Hunt brothers were buying silver and took it up to $50 back in I think the early 80s or late 70s, which was a speculative mania, this one is driven by fundamentals. We've seen for the last 5 years a deficit in mine production compared with the industrial demand. And that industrial demand is set to increase, partly from electric vehicles, where the amount of silver required is about double what you need for a conventional combustion engine. And of course, we've got an accelerating move towards solar panels, which also are big consumers of silver. So there's quite a large deficit in silver, and the only way to suck out that deficit is through higher prices. But obviously, those prices have moved very fast, and that kind of makes it, at least in the short run, kind of speculative. It doesn't mean to say that the bull market is over, not at all. But often when these things happen, you do get a sharp and unexpected pullback before the bull market can resume and go to another all-time high. But if we were to take the speculative boom of the Hunt brothers, and I think there was another one a bit later, which wasn't so much speculative, but both of them took silver to around $50, and so this time we've gone to $50. But if we adjust it for inflation, the figure I've heard quoted, and I haven't double checked myself, is we'd have to go to $180 this time around to kind of make a peak similar to the ones we've had before. So, when you have large bull markets like this, they can often overshoot. So I'd be a fool if I said it's going to turn around tomorrow. I'm not saying that. It could easily shoot up again tomorrow and the day after. But at some point, when you've got this sort of move, there has to be a pullback. And I think from here on, it's not so much of a steady rise as we have perhaps seen over the last few years. We now go into a phase where the moves are more violent, perhaps 2 steps forwards, 1.5 steps back, 2 steps forwards, 1.5 steps back. And of course, if you're a person who doesn't feel he's got enough silver, the way to play the game is to ease in gently a little bit now, which is painful because you're buying at the all-time high, but keep some in reserve so you can buy some perhaps in 10 days or 30 days time. Might be higher, might be lower, but either way, you can't be sad that you paid everything at the highest price.
Yeah, that's a great perspective. And certainly triple digit silver, you mentioned $180 there. I believe that statistic is using government inflation data. So perhaps if we're talking real world inflation, the price could be even higher to get back to that previous all-time high in real terms. You posted a video to your YouTube channel, which was rather prophetic, about 3 months ago, and it was titled "Silver Miners, the Prices Are About to Go Crazy. I name my top silver miner picks for huge gains. And silver mining stocks have indeed done very well this year, with the SIL ETF up over 130% year to date. Do you think there's still more upside to come for silver miners? Are those prices of the silver miners, obviously they're very correlated to the silver price as well. So do you kind of have the same prognosis for the equities? And could you share those silver stock picks that you're most bullish on?
Well, first of all, I haven't studied the entire market as I did 3 or 4 months ago when I did that video that you have to buy silver miners. But I have been looking in the last few days at a number of the silver miners and revaluing them. The ones I looked at, I consider still to be very undervalued at today's silver price. I would say they're probably pricing at a silver price of $25 at the moment, not $50, or now we're $57, aren't we? So if this price holds, and I think we'll have the up and down, but I think there's a floor in the range of 45 to 55 at the moment, and then we move up into the higher levels. But let's assume that range holds. Those silver miners are going to be on extremely or very low price earnings multiples next year, when we're talking about the 2026 profits, with probably a higher price than today's price. So in a doubling of the silver price from 25 to 50 doesn't mean to say the shares double. It means they do a lot more than doubling. So when I did my calculations on a number of silver miners, they all look like they got many multiples higher to go. And and you asked me to name some of them. Well, there's a lot I like. There's Majestic Silver, there's Pan American Silver, there's Silvercrest, Heckler. And by the way, I don't own many of these. I own one or two of them. Discovery Silver, Andean Precious Metals, which is gold and silver. Kingsgate Consolidated, gold and silver. Silver X is one of my favorites. It's a fairly new producer, but it's got a very, very leveraged upside. That's been one of the best performers, but I think it's going to be an absolutely phenomenal performer going forwards. And this is not investment advice. It's just my personal opinion. I've done my maths my way with my assumptions about what the silver price was. And when I did the maths, I assumed the silver price would be $50 in 2027. That's a rather conservative estimate. It could be a lot higher, but I used a $50 price and worked out what will the earnings of these companies be in 2027. And if the earnings are that, and I put a price earnings ratio, a modest price earnings ratio, by the way, I used 10 times on these companies, where do I think the share price will be? Then I compare that share price with what it is now, and there's many multiples upside. Another one which I particularly like is called Silvercorp. That's a particularly good one. But you can't really go wrong if you buy the silver mining ETFs or the silver junior mining ETF. At this point, I'd probably go for the mainstream silver miners rather than the juniors, even though the juniors potentially have I'm going to say, like, lots of juniors have huge upside. The problem is lots do not, because they're going to run out of cash. So if you're buying individual companies, and this is what I would recommend to anyone who's trying to buy silver miners, unless they really, really know what they're doing, and I would say I know enough about juniors, but unless you really know what you're doing, you should stick with the majors and the ones which are either already producing or just starting to produce. Then you know what's coming out of the ground. You can do some maths on that. You can look at how many ounces they're producing, and they say they'll produce. You can look at what the silver price is, what you think they'll get, and that's your number. You can put $50, $70, $20, whatever you like. And then you look at the cost per ounce coming out of the ground. And now you have a gross profit before other expenses. The other expenses are easy to see on the website, just deduct them. And you now have net earnings, divide that by the number of shares, and you've got an earnings per share. Multiply that earnings per share by the multiple that you want. I use 10 times, but lots of people might use 15 or 20 times. And you get to a future share price. If you can't do it yourself, get AI to do it for you. There's some very good AIs out there. Perplexity will do it. Grok will do it. Manus AI will do it. I'm guessing that ChatGPT will have a very good go at it, but ChatGPT, I'm finding, is sometimes a bit lazy and only does half the job, so I'm not really happy with it at the moment.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. That's a lot of nuggets of wisdom there. Firstly, about making sure you do the work and understand what it is you're investing in when picking individual stocks. I go the ETF route because I don't have the expertise in the silver sector. But as many viewers know, and if there's any new ones watching, you don't just buy stocks that you hear an expert recommend on a show, because unless you understand deeply what you're investing in and you have conviction, you won't know what to do if it drops, and you won't know what to do if it goes up. If it drops, should you buy more? Should you sell? If you don't understand the fundamentals of the company, it's basically a lottery ticket at that point.
By the way, a quick one. The worst thing anyone can do is Google for companies with the word silver in it, because there are far more companies with the word silver in the name which are not making profits than there are companies making profits. So if you just Google for a list of companies with the word silver in it, you'll get a huge list of silver, inverted commas, silver companies. Yeah. And if you buy that collection, you're probably going to find that most of them aren't making any profits and probably never will. And many of them will run out of money before they dig up a hole.
Yes, and failure is the norm. That's what's to be expected, especially when it comes to junior mining. But the mining industry as a whole is a very, very tough business. We've been hearing a lot of talk about continued stress on LBMA silver inventories, with many analysts seeing it as a major issue that could be one of the catalysts currently driving the silver price. I'd love to get your thoughts. Do you see there currently being a supply squeeze on at the LBMA? And if so, what could the implications be on the silver market moving forward?
I've seen a number of estimates of the shortage of silver at the LBMA. One estimate said there's only 6 weeks supply ahead, and another one said there's 4 months. So that's quite a big difference. But the bottom line is, it does seem that silver inventories at the LBMA have been shrinking for years. And of course, what's left is going to be very much spoken for in terms of it's leased out or it's held by an institution which has no plans to ever sell it at any price. So when you have a situation like that, and if the demand continues to be higher than the supply coming in, and by the way, there has recently been a report, I haven't read into it, but a report of big shipments from America to London of silver. But if the supply is not coming in, you then get a kind of leveraged situation when people want silver, but it's in short supply, because the leasing rates at one point I heard were up to 40% a year, which kind of means that people will say, you need silver? Borrow it from us and we'll charge you a lot of money. So it kind of implies that there were some real problems at the LBMA. But one of the funny things about if you have a high leasing rate, silver will flow in, because people say, I want to take advantage of it. So I don't know that it's the end of the game for LBMA, but what is clear is there's a shortage of silver in the market across the board. That's absolutely clear. There's no doubt about it. And that's why the price is going higher, and it has to go higher to suck out the recycled silver, because if you didn't have recycled silver, there wouldn't be enough to go around.
We saw a freeze on all trading at the CME last week, I believe it was Friday, on what was described as a cooling issue. Are their systems really this susceptible to technical problems? Many people online are not buying it, and a lot of people were pointing to the rising silver price as the cost. Of course, we know silver bugs love to be conspiratorial minded. I'm one of them, so I totally get it. But people were saying, okay, they took a break so that the shorts were able to get out of their positions. They're running cover for the bullion banks. I mean, there was all sorts of chatter out there on social media about what was actually happening. What are your thoughts? Do you think this really was a technical failure, or do you suspect something more sinister lurks behind the curtain?
Well, I'll tell you what I think in a second, but let's just start by saying it's never a great idea to trade a conspiracy theory.
Yeah.
So now, in this case, it obviously was rather convenient that things broke down just at the high point, just as it was hitting a peak. And in a way, one could say that maybe gave the shorts some kind of breathing space to figure out what they're going to do without getting margin calls while the silver price was hitting all-time highs. So they can't send out a margin call in the middle of the day or think about a margin call if there's no price to make a margin call. But what we did see, which was quite interesting, during the period when the shorts could no longer roll over their shorts or do whatever, or initiate new shorts, the spot price rose sharply. I think it went up by 5.7% on the day. So in one sense, that kind of shows us what the real supply and demand might be if it weren't for what everyone suspects is market manipulation. And I want to stress, I'm not part of the conspiracy group. I don't really believe that there's market manipulation going on, but I have to accept that it is a possibility. But I think this overheating was just convenient and not necessarily sinister. But what causes overheating? Why that day and why not any other day? I don't know. There's got to be a nagging suspicion, but I'll put it down to randomness.
Okay, well, I want to shift to the gold sector now. Obviously, both gold and gold miners have also been performing exceptionally well this year. What would you say are the main catalysts that brought us here? A lot of people are pointing to central bank buying, as some people even say that's the number one reason. Others point to rising geopolitical risks, debasement of the US dollar. I mean, take your pick. There's so many theories out there. So what are your thoughts? And would you say we are closer to the beginning or the end of this bull market as it stands today?
Well, I certainly don't think we're at the end or even the middle of it. I think this is late beginning. In terms of what's driving it, well, we've got a lot of things driving it at the moment. Some of them have been around for a few years and some of them are relatively new. We've got the fiscal deficits in the United States. So let's face it, what happens in the United States is very important to the value of gold and silver, because the less confidence people have in the US dollar, the more they're going to look for alternatives. And at the moment, there doesn't seem to be enough actions to address those deficits, which are set to be the largest ever on record this year. This year started in October. That's the fiscal year for the United States. So it's going to be at least 2 trillion of deficit, the highest ever. We've got lower rates coming from the Federal Reserve, or at least that's the opinion at the moment. Now that can change because I know it's not 100% certain they'll lower rates in December. But the opinion at the moment is we still got lower rates coming. Then we've got central bank buying at record levels for the last 3 years. So central banks have shown over the last 3 years buying 1,000 tons of gold a year on average over the last 3 years. They've basically shown that they don't care about what the price is. They just want more gold. And there's a good reason to want more gold. And that is, we've seen a certain weaponization of the dollar. And it doesn't really matter whether you're friends or enemies with the United States. You've got to think, what if I suddenly can't get my hands on, or I can't deploy my dollars for some reason? There's been a lot of surprises in the last 11 months. If you know what I mean, surprises that people never saw coming, and a lot of seesaw, whipsawing back, they call it the taco thing, the taco trade, Trump always chickens that, but it's not really that. But the point is, you don't know where you stand from one day to the next. One day you've got a tariff, next day you don't, then you do, and then there's a retaliation from another country. So things are a bit chaotic, when it comes to, investing and particularly relying on the dollar. So I think people are looking for something which can't be restricted, can't go to zero. So in that respect, gold is coming in. So then we've got the geopolitical events going on. That's not new. geopolitical events have always been there, but obviously people think that there's a heightened tension at the moment. And that, again, is a reason why people would want to lay their hands on some gold. When I say people, I'm talking about countries. And a lot of the buying has been coming from third world countries, like China, Kazakhstan, Poland, those sort of things. I don't mean to be derogatory to call them third world countries. They call them, not the Western countries, shall we say. That's kind of what I meant. That's kind of where the buying is coming from, countries which are maybe not, as of today, the greatest friends of the United States. They're not enemies either particularly, but, they're just, well, maybe some of them are, but they're just sort of saying, let's get some just in case. But I think there's also something going to continue to drive it in the next few years, probably out to 2027, 28, 29. And that's the coming digitization of currencies. We've got, starting next year, the rollout, to start with, of the digital euro, and that will go fully live the year after that. Now, I don't want to go into too many details because it's a very, very long topic, but the long and short of it is, I think you better get your gold before you've got the digital euro arrives. I think that's and if anyone wants to know why, look at my last video, but really get your get your real gold before the digital euro arrives, because you will perhaps find that you will no longer be able to deploy your assets in the way you want, your money in the bank in the way you want to.
That's very interesting. Actually, I'd love to dive a little bit deeper into that. Now, first of all, do you think the EU will actually be able to roll out the digital euro on time? Because just to give one example, for years now, they've been trying to roll out this new airport security at all EU member states, where they're going to take your biometrics. And this was announced year after year. It's coming next year. It's coming next year. It was supposed to be coming in October or November of this year. And then they said it's coming at the end of 2026 now, or 2027. So do you think they're actually going to be on time and on budget when it comes to the rollout of the digital euro, first of all? And second of all, what are the implications that you see if they do roll it out in the way that they are intending? Why is it that we need to have our hands on gold? What are we protecting ourselves from in that situation?
Well, I don't know where they are, other than what they've said, which is they're going to roll it out. Obviously, I'm not a software engineer in that respect, and I'll just comment on this airport security thing. I mean, saying that it's not working properly, I wonder what they're playing at, because the technology, facial recognition, works 100% perfectly. I was in China about a month ago for 2 weeks, and I had to get my face scanned to go into the apartment block where I was staying. So as you walk into the area, it recognizes your face, the doors open. It knows who you are by your face. As you get to the building, the door unlocks because it sees your face. You don't have to press a button. You don't have to look at the screen. It knows who you are. And as you go into the building, it knows what floor you're going to, and the floor on the lift, the floor lights up. You can't press another button. It knows. So facial recognition works 100% perfectly. It can't make a mistake. So I don't know what the problem is in the airports. I really don't. But anyway, do I think it's going to come? They say it will, so you've got to go with what they say. And the real problem here is, there's lots of problems, but let me talk about one. The limit of what you'll be able to put into your wallet will be 3,000 euros. Or it might change slightly, but they say it's going to be 3,000 euros. That doesn't sound like a lot. And so as extra money comes into your wallet, there'll be an auto sweep into your bank account. And if you spend more than 3,000 euros from your wallet, there'll be an auto sweep out of your bank account into your digital wallet. Now we've got to remember that digital euros are not the euros in your bank. It's like changing, Irish euros for German euros. Looks like the same thing, but well, they technically are, or 100 cents for a dollar. It looks like the same thing, but it's not. The digital euros are a direct liability of the central bank. The euros that you hold in your bank are created by a roundabout method by the banks themselves, where they set it around hundreds of times. And the reason you can know that for sure is the amount of bank deposits is, I haven't got the figure, it's many, many tens or hundreds of multiples of the money which has been issued by the Federal Reserve, the liability on the balance sheet. So what you're going to get with digital dollars is a liability of the central bank to you. Now, I'm just making a point here, which I'll come back to. It's not the same thing, digital dollars and dollars in your bank. But you won't be able to put more than 3,000 euros in your bank, but you will have this automatic sweep where it's 1-to-1 and you have no worries for the time being. The first problem which might arise is when the small savers in France or Germany, Italy, start to withdraw their deposits from the smaller banks. So the smaller banks deal with small people. Usually they're free services, they're online services. So a lot of money will be withdrawn by people filling up their wallets with all they've got. They might have 1,000 euros or 2,000 euros. The estimates are that 3,000 euro limit will still take 10% of all the deposits in the banking system. But if most of those withdrawals come from the smaller banks, it's going to create a liquidity problem for the smaller banks because they've lent their money out long term on car loans and hi-fi loans and to some extent mortgages. Now, the ECB knows this. It's not like they're in Clive Cuckoo land. They know this is a real danger. So the plan is to incentivize people to do what's necessary to save the banking system if it becomes necessary. What they don't know is, will all that money move into the wallets, or will people just say, not having any of this, they won't touch it? But they have a plan if it does happen, and the plan relates to incentives to ensure that you put money back in the bank if it becomes problematical. Negative rates. Basically, the real plan is negative rates if necessary. So you'll find money goes into your wallet and you say, oh my God, they're paying me negative rate. I'll put it back in my bank. Thank you very much. But then down the line, what will come will be a law, and this won't be immediate, but it'll be a year or two's time, which basically says all transactions have to flow through your digital wallet, whether you're buying a house or a car or going to eat your lunch. The money will flow out of your bank to your digital wallet, go through your digital wallet, and you buy what you want, or you go back into your wallet and then back to your bank. They'll say that's necessary to make sure everyone's paying their taxes, to make sure there's no money laundering, to make sure there's no terrorism. And, we'll all cheer that. Oh yeah, quite justified. We don't want any of that, do we? But the problem with that is now there's a potential control. Let's say we run into a crisis. Let's say we get into this sort of banking crisis where everybody's putting their money in the digital wallet, and some of the smaller banks are starting to have funding problems because the big banks say we won't lend you to you, we can't trust you. Then the big banks stop trusting each other. We're back in a 2008 situation where no bank trusts each other. Then we have a financial crisis. So they have to bring in emergency rules. And what's that emergency rule going to be? It's going to be a limitation on what you can do with your digital wallet. So you want to buy a car? Well, sorry, this week, just temporarily, you can't move more than 1,000 euros into your digital wallet, or zero, to deal with this emergency. Whatever, we don't know what the emergency will be. It could be lots of things. We now have two currencies, the digital euro, liability of the central bank, and the old euro, liability of your bank. So if you can't spend your old euro, how much is it worth? Nothing. So on day one, when they put in this temporary restriction, you'll be lucky to get 70 cents on the black market or the alternative market, whatever people decide to call it. 3 months later, you'll be lucky to get 20 cents for your euros in the bank. And a year later, you won't get anything. And that would be absolutely brilliant for the government because effectively their entire debt is in the old euro. It's not in central bank. It's not in it's not in liabilities of the central bank. So their entire debt, the government's debt, which is way too high and unmanageable at the moment, effectively becomes worthless. So they can now start borrowing again in the new euro, the digital euro, with a debt to GDP ratio of the new euro of 0, without defaulting on the old one, because they're going to repay you in worthless euros, which you can't spend. A kind of debt jubilee. Now, To what extent it plays out like I've just described, there's many scenarios, but the bottom line is if you have euros in the bank, one way or another, either through high inflation or through confiscation or through a forced buy-in of government bonds or a bail-in or something else, or a splitting of the currency into two currencies where you've got the digital euro and the other euro, which isn't worth as much. We don't know how it's going to work, but something has to happen because the debt is too high and it can't be sustained at these levels. And I'm not talking about just Europe. I think Europe would potentially be the first, but behind that we've got the UK, USA potentially, and many, many other countries which might go down the same kind of routes. But all these Western countries have got the same problem, which is one of too much debt. It's not going to last. So something breaks at some point. We don't know when or how or where, but when it breaks in one place, everybody in every other country is going to say, are we next?
Yeah, great summary and great outline of some of the potential scenarios that people can prepare themselves for.
That's why you should get your goal now. Get your goal while you can. That's what I'm saying.
Absolutely. I want to talk about the AI revolution and what many are calling a bubble in the stock market driven by AI. There's so much hype behind AI, but in terms of real world applications, it feels like much of the sector is trading on hopes for the future, especially when we consider profitability as one of the requirements. You mentioned using AI to evaluate companies. I do it to break down earnings reports sometimes, and it's a very useful tool in that sense. You can make cool videos and graphics, but in terms of world-changing dynamics, I don't think we've seen a lot yet, perhaps replacing some entry-level positions. But the idea that, AI is going to put everybody out of the workforce and take over the world, do you think that's a realistic proposition? Or do you think we're kind of, it's a house of cards potentially at this point? And if so, do you expect it to collapse in the either weeks, months, years ahead?
There's two things there. One, what's the effect on the workforce? And two, what's going to happen to the share prices of these companies? We have the entire stock markets of the world, not just the USA, relying on a very small handful of companies, the top 10 US companies, if you like, or top 10 AI companies in America. And those companies have some very optimistic assumptions. When I say they have, the world has very optimistic assumptions about them, optimistic about the margins they'll be able to make in the future, optimistic about the growth, and optimistic about where the demand is going to lie. So these companies are all priced to a large extent on future hope, which is why we're seeing price earnings multiples of around, let's say, 40, for example. So the global indices really are relying on these 10 stocks. So what these 10 stocks do is what the world indices are going to do, up or down. Now, I'm not one to say that because something's overpriced, it has to go back to fair value. There's no such rule in the stock market and never has been. At some point it does, but it's not. I mean, the classic example of why it doesn't is go back to the irrational exuberance expression of Alan Greenspan in 1996. He was 3.5 years too early, so stocks were crazy prices in 1996, just way too high. Every company which came out before that was get an email address, the price goes up. Then you get a .com, you get a domain, and your price goes up. So prices were going crazy on the .com. They called it the .com bubble at the end because companies were coming out and inventing themselves with no revenue and adding .com at the end. And so that was absolutely totally crazy. But in the earlier stages, these were companies which were making profits, did have revenues, were still seeing their share price go to the roof because they got an email address or because they got a domain name. And Alan Greenspan quite rightly called it irrational exuberance, yet the market didn't crack. It carried on for, I think, 3.5 years, and you'd have made several 100%, and a lot more if you'd been in NASDAQ stocks, but you'd have made several 100% just being in the S&P 500 after stocks were way too high. So if I tell you that they're overpriced, which is the case, I'm not saying they're not going to go up for another 2.5, 3 years. We don't know. So will they crash? Yes, we could easily go back to, at some point, some sort of normality, especially if these growth expectations don't come to fruition. If we take the largest company, OpenAI, which owns ChatGPT, their revenues last year were but a tiny fraction of their costs. I think you'd have to, so the average fee for a person like you and I on ChatGPT is about $20 a month. I think you'd have to be paying about $100 a month if you want ChatGPT to make a profit. And don't forget, there's all these other competitors to ChatGPT, which are also getting better day by day, from Grok to Perplexity to Manas to Copilot to Gemini and loads of others, and there's going to be a lot more in the future. So competition is a big thing. So even though there's more and more of us using AI on a day-by-day basis, that those new users are getting divided up amongst a larger array of companies which are offering these AI services. So perhaps the growth there'll be a huge growth in end users going into AI. The growth for each company doing it may not be that as high as they're pricing it at the moment. So when reality sets in, we could easily have a collapse in share prices. But I want to get a stress. This is going to be driven by psychology. It's not because something's overpriced that it goes down. That's just not the way the markets work. Markets are driven by psychology. So when the psychology changes, if the psychology changes, and it always does at some point, that's when we get the crash. And of course, when that happens, gold, I think people will say, well, what's going to happen to gold and silver? Well, I can tell you, when a crash happens anywhere on the planet, when something fails, everything on the planet goes down. There's nothing escaping from it. But then the most solid assets recover first. So I think that, if we do have a sudden, 30% crash, for example, at some point, gold and silver and, obviously the miners, even more so, will be taken down with it, because margin calls literally do not care whether your stock is good or bad. A margin call is a margin call. You have to sell. There is no choice. So everything gets sold. But when the recovery comes, now people have got cash, they'll go for the safe assets, and the safe asset will be gold, especially gold, and I am guessing silver as well, but I think they'll go for gold. And of course, when that happens, the huge drop we'll have seen in gold and silver miners will come back very sharply. But is it tomorrow? Statistics say no. If those who bet on a crash are usually wrong.
You recently posted on LinkedIn the results of your 2025 Beat the Benchmark portfolio, which is currently up around 37% year to date. It's constructed with 40 stocks and contains, quote, no AI stocks, no Mag 7 or FANG stocks. There were no gold or silver mining companies. There was no exposure to Bitcoin or other crypto stocks. Now, you posted the whole list of companies on LinkedIn, so I recommend people follow you there. I'll put a link in the description below, and they can check that out. But could you shed some light on how you constructed that portfolio and why you think it managed to outperform the broad market this year?
So I've been doing this for many, many years. I've been investing in stocks for 50 odd years. A couple of years ago, I started publishing my portfolio, call it Beat the Benchmark 2024, Beat the Benchmark 2025, and so forth, on LinkedIn, as opposed to the platforms I used previously, which was more with my clients. It takes a lot of courage to come out and publish a portfolio at the start of the year, because people can make a fool of you if it underperforms. They can say, "Oh, look, this guy did that, ha ha ha." But I've had a lot of success in beating the benchmark over the decades, and I had enough confidence to say, if I don't, it won't be that bad. And let's just say I usually beat the benchmark, and I aim to beat every benchmark. Now, how do I do it? Well, first of all, I try not to buy companies which are going to be driven by speculation. So that's why there was no gold or gold mining, no Bitcoin or Bitcoin mining, and no AI stocks. I wanted companies which make genuine products or do things which everybody wants, which aren't in the spotlight of investor mania, which could go either way, of course. I just wanted companies which are increasing their turnover, increasing their profits, have good cash flow, have a lot of safety overall. So I was looking for a lot of features like that. Um, and the way I did it, I described it in a video I did about 8 days ago. So if people want to go to my channel, which is Clive Thompson on YouTube, just look up Clive Thompson and look up perhaps the words "beat the benchmark," for example, and you'll find that video. There's a video called how to build a benchmark beating portfolio in 2026 or something like that. So beat the benchmark and Clive Thompson. I think you'll find it. I describe in words of one syllable how to pick the stocks yourself. I'm using a free application on the internet. At least it's free for up to 10 stocks. So it's basically a filtering system where you pick certain attractive features, and I describe what those attractive features are. I describe how to use the tool. It's called Simply Wall Street. And you can go in there and you can then filter down to find stocks which have those attractive features. There's one more step you need to do after you've found a list of attractive companies by feature. So one feature might be high growth. Another feature might be high momentum. Another feature might be very cheap. Another feature might be high dividend. There's lots of features. Another feature might be insider buying. I never do one feature on its own. I use combination of features, several features. But the last step you need to do is when you've got your list to go and look at the website of each company to see if there's any news which you need to be aware of before you make your final decision. But the good news is your starting point is you've got a list of high quality companies which meet good criteria for investment to start with. And if you look at the website and you see the news, you could then say, I didn't want to buy that one because it's being taken over by another company. Therefore, the upside is limited, for example. So, because when you're filtering, it won't spot that there's a takeover in progress, or it won't spot that a company has been suspended, for example, because maybe there's been a regulatory failure or something.
Great. Well, I'm going to put a link in the description to your YouTube channel as well. Clive, this has been a great conversation. For those who want to follow your work, is the best place to go LinkedIn and YouTube? Is there any other platforms that people should be aware of?
No, just look for Clive Thompson on LinkedIn. I publish twice a week with an article about finance, about gold, about silver, about platinum, or about Bitcoin, or about stocks. I mean, also sometimes the daily news. And YouTube, it's about twice a week with a video on a topic. One of the favorite topics amongst my viewers is from time to time I do videos for complete beginners in stock market investing. So for those who've never invested in stocks before or don't understand how to pick the best stocks, there are videos I'm putting up about that. And a lot of people are showing those videos to their children because they think their children are not getting any financial education from the schools, and they want their children to be aware of finance because one day they're going to inherit their mum and dad's fortune, and the sooner they learn, the better.
Absolutely. And that's fantastic. I've been following your YouTube channel for a while now. Great content. As I mentioned, link will be in the description to both Clive's YouTube channel as well as LinkedIn. So I recommend people follow you there as well. Clive, thank you so much for coming on and sharing your knowledge with the audience.
Thanks very much. And bye-bye to all my listeners and all your listeners.
Thank you for joining us today. This episode is brought to you by ARK, Silver, Gold, Osmium. Their prices are appearing on your screen right now. These are all well, supplies last, and subject to change. Reach out to owner Ian Everard today to take advantage at 307-264-9441 or by email at ian@arksgo.com, and make sure to tell him that Commodity Culture sent you, and pick up your Commodity Culture merch. Rep the show in style, everything backed by a 100% quality guarantee. Use the link in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.